What is the best financial advice you've ever received?
Invest in assets, not liabilities.
A FINRA study found that only 40% of the people polled could answer 4 out of 6 basic financial literacy questions.
Welcome to Eagle Finance. If you are in 20s, how to make a financial plan? Are you managing your money in the best possible way? If the answer is no, you are at your right place. In the previous video, we discussed the importance of financial planning. In this video, let us discuss how to create a financial plan. Create a plan today for yourself. Unless you do so, you will be shooting in the dark. Very first principle in the financial independence is ensuring the safety of life from the financial point of view. Let us go to the personal finance calculator to find how safe anyone's life is. This is the retirement corpus calculator reference from Wintwealth Company. You have to give basic inputs like present age and target retirement. Also, please note that you can only change the yellow highlighted cells. There is a section for existing investments which include EPF, PPF, fixed deposit, bank balance, real estate, mutual funds, and stocks. You can input the values here. And then there is a separate section for future investments which include monthly income, average monthly expenses, and investments that you are making per month. Also, please observe that separate section is added for the future goals. And then amount of corpus left at the life expectancy is calculated here and then highlighted in green. You can observe it is a positive value, which means even after life expectancy, we are left with some money. Objective of this calculator is to reduce the retirement age. Let us put the retirement age as 50 and check. You can see amount of corpus is negative, which means the existing investments and the future investments I am going to make are not sufficient to meet the basic necessities. I will provide the calculator in the description, hence you can use it. You may be getting a home from your parents which has value to it. If you want to live in the same home, try not to include that in this real estate row, because nobody wants to sell off their home and meet basic food necessities. If you have any other real estate, you can include here. If you are clear that you should invest in quality businesses, next question is how much of your salary you should invest. There is no hard rule. General rule of thumb is to allocate 50% of your salary to essential expenses, 30% to discretionary spending, and at least 20% to savings and investments. Follow-up question will be where to invest. Multiple options are available in the market. It is important to not adhere to the age-old wisdom of investing heavily in fixed deposit, real estate, and gold. Observe your parents or grandparents who invested only in these 3 assets. These assets gave poor return compared to stocks in past 10 decades. Reference from book Coffee Can Investing. Okay, you opted to invest in stocks, but there are 6,800 stocks in the Indian stock market alone. How do you select from the pool? Let us deep dive into it. As per industry standards, these stocks are divided into 3 types: large cap, mid cap, and small cap. Large cap are those businesses that are well established and have a significant market share, like market capitalization of 20,000 crore or more. Do you know what is market capitalization? Comment below if you know. Mid cap companies are those with market caps above 5,000 crore but less than 20,000 crore. Small cap companies are those that have market capitalization of less than 5,000 crore. Over the past 2 decades, small caps have outperformed large caps in the most large stock markets. Smaller companies have the potential to grow their businesses much faster than larger companies. As they grow, they will be discovered by the stock market and attract research attention. But they are also risky if you are selecting without proper knowledge. If you are in your 20s, no one is financially dependent on you. Hence, riskability should be high and we should invest more in small caps. You can see a fraction of investments to be made in small caps at the end of the video. Before investing in any stocks, do fundamental analysis of stocks. Fundamental analysis is nothing but a quality check on the businesses. Steps to analyze stocks. Step 1 is to select some 15 to 20 stocks from the stock market website by applying basic filters like return on equity more than 15%, market capitalization more than 100 crores, sales growth more than 10%, net profit margin more than 15%, and cash flow positives, etc. For example, have you looked at this Excel where I did analysis for 16 companies that I selected from step 1. Step 2 is to do further analysis on 16 stocks by performing a quality check on the balance sheet, income statement, and cash flow statements. For example, in this Excel, capital work in progress CWIP for specific companies is significantly more than industry average. There is a higher chance of accounting fraud. Such companies can be filtered in this step. Check out the iCard for more details on CWIP. Step 3 is in-depth analysis of 14 stocks that are passed through step 2 and selecting 3 to 4 stocks. Step 4 is fine-tuning the 3 stocks by doing management analysis, valuation checks, and investing in final selected stocks. All this process takes quite a lot of time, but returns will be better. If you want details on any financial terms being used in this video, comment below and subscribe. To summarize everything, use the calculator to find retirement corpus, back calculate and set a goal for periodic investment in high return stocks. Do not forget to do fundamental analysis of any business that you are investing. If you like the video, consider subscribing to Eagle Finance for more finance related content.